Welcome back to the Phuble podcast, where we talk about all financial markets around the world. I am Philemon Viennis, and this podcast is sponsored by Phuble, the social networking platform for any and all investors. I almost messed that part up right there. Today is Friday, August 16th, 2019. So we'll just go over a brief overview of what happened this past week. Starting off with the indices, all major U.S. indices finished the week pretty decently after a significant drop at the beginning of the week. There was a day, I don't remember if it was either Tuesday or Wednesday, I think, when all the major indices were almost down 3% each, which was a huge decline. But they ended up kind of bouncing back somewhat toward the end of the week. The S&P 500 finished the week at 2,888. The Dow Jones finished the week at 25,886. And the NASDAQ finished the week at 7,895. Like I said, this was a huge bounce back from the beginning of the week where all major indices virtually crashed. And that was due to many uncertainties with the market. The foremost uncertainty being the U.S. 10-year Treasury bond. The interest rate of the U.S. 10-year Treasury bond declined below the 2-year U.S. Treasury bond. So the bond yield curve inverted at the beginning of the week. And that signals a recession. That's been a historical indicator for a recession when that bond yield inverts. And it did invert for the first time since 2007, which of course was the Great Recession. I'll go over the bond yields in a moment, but first let's get to gold. Gold currently is at 1,513. Finished the week pretty strong. It was down today, but it's been going up. That is, of course, the U.S. Gold Spot Index, not the COMEX price. This is the spot index. So basically what people will pay for gold right now per ounce. And it's been going up, as I mentioned before in the other podcast. It's going to keep going up. Gold is like a safe haven for investors. So when they feel that the market is uncertain or volatile, people go into gold, which is why it's been increasing, which is why it's going to keep increasing. Oil finished the week pretty high. Brent finished at $58.64. WTI finished the week at $54.87. Oil is going to decline in the future. I think, like I mentioned on the previous podcast, I don't see any really real catalyst to drive it up past like $65 in the near future. I don't think that the price of oil is going to go too much higher, at least finishing out the end of the year. I don't foresee anything. I think oil is going to kind of hover in the range of like $55 to $65 for both WTI and Brent. I think it's kind of going to stay in that range. It might dip below like $50 for maybe a week or two to finish out the year, but I think it's going to mostly be between $55 and $65. Okay, let's get to bonds, because this was a big deal earlier this week. As I said, when an inversion happens, that signals a recession. Basically, it means that you will earn less on interest rates in the future than you will in the present. You'll earn more by investing now than you will in the future. That's basically what it signals. The timeline for the maturity of a bond should always be that the longer it takes for a bond to mature, obviously the more uncertainty there is in the world, so you should be given a premium interest rate for that bond. When more recent bonds, the 2-year bond, of course, has a higher interest rate than the 10-year bond, it means that the market foresees the Federal Reserve Bank cutting interest rates in the future to stimulate the economy, which means that there's going to be a recession. And like I said, it has signaled a recession in the past. In recent history, it has always signaled a recession. This time might be a little different. So the 2-year right now is at 148 The interest rate is at 148. The 10-year is at 155. So the curve isn't inverted anymore. It was earlier. I think it was inverted for a day or two, but it's not inverted anymore. This time may be different than in the past because there are negative interest rates around the world for national banks because, like I've mentioned before, there's a global economic slowdown. So in order to stimulate the economies of especially European countries, the European Central Bank has lowered interest rates to the point where they are negative. That means that it's encouraging investors to dump money into the U.S. And into U.S. bonds because they can earn a better interest rate, obviously, in the U.S. than they can pretty much anywhere else in the world. What that does is that drives up the price of bonds because more money is coming in. When bond prices go up, the interest rate gets driven down. It's a rule of thumb. Bond prices go up, interest rates go down. The interest rates are being driven down by this influx of cash, not so much by investors anticipating that the yield will be lower in the future. It might be different this time. I still think the U.S. is going to go through economic slowdown. I still think there's a recession coming. But I don't know if this really signals that a recession will happen. I don't know. I don't think it does. Just because investors outside the U.S. are dumping money in the U.S. because they can get better returns on their money on bonds within the U.S. than they can in their own countries or anywhere else abroad. What this does, though, is this crushes the stock prices of banks. I have three bank stocks shown behind me. All three of these stocks I think are fantastic buys. They all are extremely undervalued. We have JP Morgan, Bank of America, and Goldman Sachs. Their PE ratios range between 9 and 11, which is insane. They're great companies. You have to be careful with bank stocks because if the inversion continues to happen, the price might be driven lower because banks save money on the long end and they borrow money on the short end. What that means is banks take out loans, if you will, on a short-term basis, and then they save money on a long-term basis. And that's kind of how they make some of their money. So if the long-end interest rates are lower than the short-term interest rates and they're borrowing money on the short-term interest rates, they're going to be losing money over that stretch of time. They're still good companies. I would wait to buy banks. Even though they have fantastic PE ratios, they're great companies, I would wait because I think the price is going to get driven down even farther, especially going into the new year, into 2020. But these prices are unbeatable. They're most likely still going to go down. They would be good pickups going into the new year. They're just fantastic companies, but you have to be careful because theoretically they could still lose money if those interest rates if the curve is inverted. They're going to lose money. All right, GE. I'm just going to go over this very fast. GE got accused of insurance fraud, I believe, by the guy who outed the Bernie Madoff scandal. I don't like GE. I don't think they're a good company anymore. I wouldn't touch them. If this is true, this stock is going to get driven down probably close to $2. If you're in a position to short GE, which means bet against the stock, I would, because this claim is going to do more harm to the stock in the short term. It just will. Bad news always decreases the stock more than good news increases the stock. So GE is definitely a company I would short. If this is true, they're in trouble. Like, they're in really bad trouble. To the point where it's going to absolutely crush the company. They might have to just spin off all their units or dissolve completely. This scandal could be the end of GE if it's true. I don't know if it's true. I don't know if it has any backing. Larry Culp, the CEO, already said it's not true. I don't know. He bought back a bunch of shares when the stock declined earlier this week. I don't know. It's a good stock to short, though, I believe. All right, Hong Kong. Hong Kong is still having issues. The Hang Seng kind of leveled out this week. Hang Seng is at 25,734. I don't know what's going to happen with Hong Kong. I still think Xi Jinping is going to have to give in to the protesters. I think Carrie Lam is going to have to give in to the protesters. That's the only way I really see this thing ending. Xi Jinping does not want to send in the PLA, which is the Chinese army, to really suppress these protesters. That does not look good for him. That doesn't look good for the country. It's going to get more worse, I think, before it gets better. But I do think he is going to give in to the protesters. I don't see a way that this thing ends good for China if he doesn't, and I think he knows that. Donald Trump pushed back the tariffs that were set, I believe, on September 1st. He pushed those back to December. The 10% tariff was set to be imposed on Chinese products starting September 1st, and now he pushed it back to December. He didn't do this for any reason but the stock market. That's it. He plays the short-term game. That's his judge of how he's performing as a president, is the stock market. So he honestly is the biggest market manipulator I have ever seen in my entire life. But he plays things on a short-term basis. Whatever will rise the stock market in the current day or the current week, which is dangerous. That is very dangerous to do. I hate tariffs. I think they're stupid. I think they're the worst thing that you can do to a global economy is tariffs. I'm glad he pushed them back. It gives more time, but he only did this to increase the stock market. That's it. The U.S. stock market, that is purely it. Because the Dow, S&P, NASDAQ, all the major indices were getting destroyed earlier in the week. He announced that they started to go back up. I don't really see the China-U.S. trade agreement getting solved until after the presidential election next year. I don't. And it's dumb. Honestly, it's costing both countries more than what it's worth, which is the IP issue. That's the huge issue with the trade agreement, is China stealing the intellectual property of the United States. I don't see it getting solved until the presidential election. There's too much for China to lose agreeing to something that, if Donald Trump isn't reelected, would get solved. Last thing for the week, Walmart did amazing on earnings. Same store sales for the second quarter increased 2.8%. That was huge. E-commerce sales increased 37%. Also huge. Revenue was $130.38 billion. Earnings per share were $1.27 per share. That was over estimates. Estimates were $130.11 billion for revenue and $1.22 per share. The big thing, like I mentioned, was same-store sales. That means that Walmart is really doing well with management in their existing stores, and they have really started to take a market share in the e-commerce space. Walmart is at $112.99 as of today. They're a good company. I would not buy Walmart because I think consumer growth is going to slow. I do. And I don't think they're going to be able to pull numbers like that, at least going into 2020. I don't think. Maybe in Q3 they will be able to. I wouldn't buy them, even though I do think they're a good company. I just think that they're competing with a lot. But retail metrics came out for the U.S. for July, and it showed basically strong consumer spending. Retail sales increased 0.7% and 0.3% was forecasted. What was an even bigger story was sales increased 2.8% for internet retailers like Amazon. That could just be due to Amazon Prime Day, honestly, because that was in July. Basically, when Amazon has that event, people get online, they shop not only on Amazon but on other online stores as well. Kind of gets them in the buying mood. I don't know if that's a really good judge of the strength of the consumer, but it is positive news for sure. I expect that we're going to get good earnings numbers going into the rest of August and September, all the way up to probably November. And then we're probably going to see a slowing. Based off of these numbers, it does signal that the U.S. does have a great advantage with consumer spending compared to the rest of the world, and that the consumer is still able to spend money within the US, which is very positive for the economy. Okay, thank you all for watching the Phuble podcast. Make sure to subscribe. We will be here next week. Happy investing.